Knight-Swift just delivered a massive beat for Q2, absolutely crushing consensus. I mean, revenue hit $2.1 billion, which is up 12.6% year over year, and adjusted EPS surged 80% to 63 cents.
Yeah, and they guided Q3 adjusted EPS to a very strong 71 to 77 cents. The stock is naturally popping on this report today because, these numbers are just wild for a freight company right now.
Right, exactly. So welcome to today's deep dive. We are taking this specific earnings report from Knight-Swift, ticker KNX, and decoding what it means for the global supply chain.
Because they are the largest full truckload fleet in North America. So when they report numbers like a GAAP net income of $43.2 million or 26 cents a share, it tells us a lot about the broader economy.
It really does. I mean, if you've ever wondered why your groceries suddenly get more expensive overnight, the answer usually isn't in the supermarket aisle, it's out on the highway.
Oh, for sure. The trucking industry is like the ultimate leading indicator. When freight markets shift, it ripples through everything. Inflation data, corporate margins, literally the price of a gallon of milk.
Exactly. And our mission today is to look at their Q2 2026 presentation from July 22nd and show you why the trucking industry is undergoing a massive foundational shift.
And you really have to look past just those headline earnings beats. You have to understand the macro environment Knight-Swift is operating in to see why they generated that kind of leverage.
Right, because looking at the conference call transcript, their CEO, Adam Miller, used some very specific language. He talked about a, quote, rapid progression in truckload market conditions.
Yeah, that phrasing is key.
What does that rapid progression actually look like when you're, out on the road?
It looks like a classic supply-driven tightening. Over the past couple of years, we had all this excess capacity built up in the trucking industry, just too many trucks.
Right.
But now we are seeing a structural shift. Supply is leaving the market. And when you have fewer trucks available industry-wide to move the exact same amount of goods, the carriers who actually own the physical assets suddenly inherit incredible pricing power.
So they can basically charge whatever they want.
Pretty much. That tightening pushes spot rates higher, and it drives up their contractual negotiations. But the most critical metric indicating this shift is what's called their tender rejection rate.
Yeah, let's pause there. Because if you aren't living in the weeds of freight logistics every day, tender rejection rate sounds like technical jargon.
It does, yeah.
I like to think of it like trying to hire a really highly recommended general contractor to remodel your kitchen.
Oh, that's a good way to look at it.
Right. Like when the housing market is slow, that contractor might take every single job you offer them. But suddenly, when a building boom hits, they start turning down jobs. They reject your tenders, basically.
Exactly, because they are booked solid. Their capacity is maxed out.
Right. They can afford to be picky and hold out for the absolute highest paying projects. So when Knight-Swift starts rejecting tenders from shippers, it means demand in the market is vastly outstripping their available supply of trucks.
And the magnitude of their specific rejection rate is what really jumps out in this report. The CEO actually noted that their tender rejection rates in the second quarter were running at roughly twice the level of public indicators.
Wow. Twice the level.
Yeah, double. They are seeing demand significantly outpace the broader market, and that gives them the ultimate leverage to just, completely optimize their network.
But hold on, I have to ask, is this just a temporary blip or is there a real physical constraint here? Because if rates are going up that much, wouldn't every carrier just buy more trucks and put them on the road?
I mean, they would if they could, but the physical constraint right now is the driver pool.
Oh, interesting.
Yeah, you can build 1,000 new trucks tomorrow, but if you don't have a qualified, licensed commercial driver to sit in the cab, just a very expensive paperweight. Knight-Swift explicitly noted a tightening driver supply, which meant they had a higher number of unseated trucks.
Just trucks sitting empty. Which brings us to the core engine of their business, the truckload segment. Because this segment makes up 61% of their total revenue.
It's their bread and butter.
Right. We are talking about roughly 14,900 irregular route tractors and another 5,800 dedicated tractors. And their revenue here, excluding the fuel surcharge, grew 2.8% to $1.1 billion.
Which is solid growth.
It is, but here's the statistic that totally jumped off the page for me. While revenue only grew 2.8%, their adjusted operating income skyrocketed 69.4% to $98.9 million.
Yeah, that's the leverage we were talking about.
And they reported their adjusted operating ratio improved by a massive 360 basis points down to 91.0%.
We should probably translate those financial metrics for you, because if you're a retail investor listening to this, you might not track operating ratio. but it is crucial to understanding this company's profitability.
Yeah, go for it. Break it down.
So in the trucking industry, operating ratio, or OR, is the ultimate scorecard. It is simply your operating expenses divided by your revenue. So an operating ratio of 91% means it costs Knight-Swift 91 cents to generate a dollar of revenue.
Leaving 9 cents of pure operating profit.
Exactly. So lower is always better when it comes to OR.
Right, okay.
And they lowered it by 360 basis points. A basis point is just a financial term for 1/100%. So 100 basis points is 1%. Lowering their OR by 360 basis points means they improve their profit margin by a full 3.6%.
Which, in an industry built on literal pennies per mile, that is a seismic shift.
It's massive.
But here's what I don't get. When I looked at the actual operating statistics, their loaded miles, meaning the actual miles driven with freight in the trailer, fell by 2.6% year over year.
Yep.
And you just mentioned the driver shortage, leaving trucks unseated. So how do you make 69% more operating income when your physical trucks are actually driving fewer loaded miles? The math feels totally contradictory.
It does feel contradictory at first, right, until you look at the mechanics of freight routing. What they did is honestly a masterclass in disciplined network management. It all comes down to ruthlessly managing what the industry calls empty miles, or deadhead.
The deadhead, right?
Yeah. Imagine a truck drops off a load of electronics in Dallas. But their next pickup is a load of paper goods 150 miles away in Austin. That truck has to drive those 150 miles completely empty.
Which means the company is burning diesel fuel, they're putting wear and tear on the tires, and paying the driver for their time, all while generating absolutely zero revenue.
Precisely. Empty miles are the ultimate margin killer in logistics. But because of that supply-driven tightening we talked about, Knight-Swift had so much demand that they could be incredibly selective about which loads they accepted.
Ah, I see.
Yeah, they used advanced routing algorithms to essentially prune the dead weight from their network. They just stopped taking loads that would leave a truck stranded in a bad market. And as a result, they reduced their empty miles by 140 basis points in the quarter.
So they are driving less overall, but every single mile they do drive is hyper-optimized for maximum profitability.
Yes. And they combined that routing efficiency with newfound pricing power. Because capacity was so tight, they increased their rate per loaded mile by 5.5%. And that momentum was actually accelerating. They noted that late in the quarter, specifically in June, their over-the-road business saw double-digit year-over-year rate improvements.
That's huge.
It is. So fewer loaded miles, drastically less wasted empty driving, and charging significantly more for the cargo they actually do move. That is the exact formula that turns a tiny 2.8% revenue bump into a nearly 70% explosion in operating profit.
Okay, that makes complete sense when you lay out the mechanics like that. But there is a dark side to this capacity crunch, because while Knight-Swift clearly benefits when deploying its own physical trucks, they also run a brokerage business.
Right, the logistics segment.
Yeah, let's pivot to logistics. This is where they hire third-party carriers to move freight for their customers. It makes up about 8% of their total revenue. And on the surface, the numbers look great. I mean, revenue grew 8.9% to $139.7 million, and the revenue per load spiked to nearly 30%.
Well, the top line looks great, but the margins reveal a pretty brutal reality. Their gross margin actually compressed by 350 basis points year over year, dropping down to just 15.4%. Yeah, and because of that severe margin squeeze, their adjusted operating income for the logistics segment actually declined by 25.7%.
So it's a textbook margin squeeze. It makes me think of, like, a catering company that signs a contract to cater a massive wedding, right?
Yeah.
And they lock in the menu prices 6 months in advance. But then the week before the wedding, some supply chain issue happens, and the wholesale cost of beef suddenly doubles.
Right.
The caterer is stuck paying those premium spot prices for the raw materials, but they can't legally charge the customer any more than the agreed-upon contract rate. They just have to eat the loss.
That analogy perfectly isolates the problem. Knight-Swift had contractual pricing agreements locked in with their shipping customers. But to actually fulfill those shipments, their brokerage arm had to go to the open spot market to rent third-party truck capacity.
And the spot market was on fire.
Exactly. Because the overall market was tightening so rapidly, the cost of that third-party spot capacity escalated way faster than the contractual pricing they could negotiate on the customer side. So purchased transportation costs just cannibalized their profit margin.
And because of that, Knight-Swift deliberately dropped their load count by 16.4%, which I have to push back here a bit. Walking away from over 16% of your volume in a single quarter seems incredibly risky.
It is a calculated risk for sure.
Doesn't turning down that much freight permanently damage your relationships with those shipping clients? Like, how do they not lose market share to competitors who are just willing to take the hit?
Well, it reveals a core philosophy of their management team. In a growth-obsessed market, a lot of logistics companies will chase volume at the expense of profitability just to maintain market share. Knight-Swift did the exact opposite.
They just said no.
Yeah, they explicitly stated they chose to maintain a disciplined approach to profitability. If a load was going to cost them more to move than they were getting paid, they simply let it go. They chose strict capital discipline over vanity top-line metrics.
That takes guts.
It does. But their thesis is that competitors who operate at a loss eventually go bankrupt, or they degrade their service quality so badly, which allows Knight-Swift to win those exact same customers back later, but on profitable terms.
Interesting.
Right,
And
yeah.
because they willingly took a hit in logistics, they had to rely on their diversified network to save the quarter. This is where the narrative shifts to how they balance out these extreme market swings.
Let's look at their less than truckload or LTL segment.
Right, which makes up 19% of their revenue.
Yeah, and the LTL segment is fundamentally different from the full truckload business. Full truckload is point-to-point, one truck, one trailer, one customer's freight. LTL is a hub-and-spoke model.
Like the airlines.
Exactly. It involves consolidating multiple smaller shipments from different customers onto a single trailer, moving it to a central hub, and then redistributing it. Now, for Q2, their LTL revenue, excluding fuel, actually decreased slightly by 1.4%, and total shipments dropped 3.7%.
But just like the truckload segment, the underlying mechanics sure they are optimizing here too. Even though shipments were down, the weight per shipment actually increased by 7.9% and the length of haul grew by 5.3%.
Which means they're taking fewer shipments, but the shipments they do take are larger, they're heavier, and they're traveling further. This increases the density of their network, which is the absolute key to profitability in a hub-and-spoke model.
Got it.
And consequently, their adjusted operating ratio for LTL improved by 100 basis points, dropping to 92.1%. They are also actively expanding their footprint, replacing 3 old facilities with larger locations and opening a brand new service center.
But if you want to talk about true scale and growth in this report, the absolute standout story is the intermodal segment.
Oh, absolutely.
For anyone unfamiliar, intermodal is where freight is moved via multiple modes of transportation without actually handling the freight itself when changing modes. So typically, a truck picks up a shipping container, drives it to a rail yard, a train carries it across the country, and then another truck picks it up at the destination.
Right, the container just moves seamlessly.
Intermodal accounts for 6% of Knight-Swift's revenue, but that revenue exploded by 34.9% year over year to $113.4 million.
The volume growth there is just staggering. I mean, their load count jumped 19.6%. Management actually noted this was their highest second quarter mark for intermodal load count since back in 2021.
That's a massive rebound.
And more importantly, they returned this segment to profitability. The operating ratio came in at 99.4%, which is a 470 basis point improvement from the previous year.
But why did intermodal thrive so dramatically while the logistics brokerage business struggled so badly? I mean, they're both essentially trying to organize complex freight movements for customers.
Well, the difference comes down to who owns the physical equipment. The bottleneck in intermodal isn't usually the train, it is the drayage.
Drayage.
Yeah, drayage is the trucking portion of the move, getting the container from the warehouse to the rail yard, and then from the destination rail yard to the final customer. It requires specialized trucks and specialized trailers, which are called chassis, to carry those containers.
And the report notes that Knight-Swift relies on its own fleet of 619 tractors and 12,498 containers to handle that drayage.
Exactly. They outsource only a low single-digit percentage of their drayage to third parties. Because they own almost 12,500 containers and the trucks to move them, they were completely insulated from that third-party capacity squeeze that decimated their logistics segment.
Oh, wow. So when demand surged, they didn't have to go beg the spot market for expensive trucks and chassis.
Nope, they just dispatched their own equipment. It proves a fundamental thesis in logistics. In a tightening, supply-constrained environment, the companies that own and operate the physical assets hold all the leverage.
That is fascinating. So we have established how Knight-Swift is routing its physical trucks and optimizing its actual freight network. But to truly understand a company of this scale, we have to look at how they are moving their money.
Right, the financial engineering.
Because the financial maneuvers detailed in this earnings release are just as critical to their long-term dominance as their tender rejection rates.
Their balance sheet strategy this quarter was brilliant, honestly. They executed a massive capital structure maneuver by issuing $1.5 billion in senior unsecured convertible notes. These notes mature in 5.5 years, and they carry a remarkably low fixed interest rate of just 1.0%.
Wait, I need to stop you right there. 1%.
1.0%, yeah.
In an economic environment where borrowing costs are incredibly high, securing $1.5 billion at a 1.0% interest rate is practically free money. How did they deploy that capital?
Well, they took that $1.5 billion and immediately used it to repay their floating rate senior credit facility borrowings. And those floating rate loans were sitting at an interest rate of approximately 4.9%.
Oh, I see. So it is essentially like refinancing high-interest credit card debt with a super low-interest mortgage. They swapped $1.5 billion of expensive variable rate debt for ultra-cheap fixed-rate debt.
That is the perfect analogy. And their slide presentation notes that this maneuver generates an annual pre-tax benefit of roughly $44 million, which translates directly to about 20 cents per share in EPS savings.
That's a huge win for the bottom line. Okay, but as an investor, whenever I hear the phrase convertible notes, red flags go up for me.
Oh, sure. Dilution.
Right. Convertible debt means that if the stock price rises to a certain level, the bondholders can just convert their debt into equity. That floods the market with millions of new shares, which drastically dilutes the value of the shares held by existing investors. Isn't that a massive risk?
It is a huge risk, which is exactly why management anticipated that concern and executed a pretty complex financial hedge alongside it. Along with issuing the convertible notes, they actually purchased a $107 million call spread.
Okay, let's break down the mechanics of a call spread for you listening at home. How does spending $107 million on a financial derivative actually protect the everyday shareholder from dilution?
Think of the call spread as a very specific insurance policy against their own stock price going up too much. So the base conversion price of those notes, the price at which bondholders could normally start turning their debt into new shares, was $80.11.
Okay.
By purchasing the call spread, Knight-Swift effectively bought options from a financial institution that offset that conversion right up to a much higher price limit.
So they basically paid a premium to raise the ceiling.
Exactly. They brought the effective conversion price all the way up to $104.75 per share. So the stock has to rise significantly higher, well past $104, before existing shareholders face any meaningful dilution.
That is an absolute masterstroke. They get the immediate tangible benefit of a 1.0% interest rate to slash their borrowing costs today, while virtually eliminating the near-term risk of share dilution.
It's incredibly smart capital management.
And we see exactly what they plan to do with that financial flexibility when we look at their capital expenditure guidance.
Right, because they are projecting $600 to $650 million in full-year net cash capital expenditures for 2026. And this isn't money earmarked for buying other companies. This is pure reinvestment.
Just pouring it back into the business.
Yeah, they're replacing older tractors and trailers, investing in their terminal network, building out driver amenities, and upgrading their routing technology.
This is where the gap between the massive players and the smaller fleets really widens. While smaller competitors are saddled with high-interest floating rate debt and are forced to cut back on investments just to survive, Knight-Swift is using their massive interest savings to continually modernize their fleet.
Which is a compounding advantage.
Exactly. A younger fleet means better fuel efficiency and lower maintenance costs. That feeds right back into lowering that operating ratio we discussed earlier.
It creates a virtually unstoppable feedback loop. Lower operating costs generate higher free cash flow, which allows for better financing terms, which then funds further operational improvements. And this brings us right to their forward guidance. Let's hear it. Management is guiding for Q3 adjusted EPS in the range of 71 to 77 cents. They are anticipating truckload revenue to be up mid-single digits year over year. But most incredibly, they expect the adjusted operating ratio in the truckload segment to improve by another 650 to 750 basis points year over year.
Wait, another 650 to 750 basis points? That guidance is a massive vote of confidence. It suggests management strongly believes the momentum they saw in June, those double-digit rate improvements, is not just going to hold, but actually accelerate through the back half of the year.
Yeah, they are extremely bullish. They're forecasting that the logistics segment will remain fairly stable, meaning they don't expect the brokerage margin squeeze to get any worse. but they are clearly relying on the sheer force of their asset-heavy truckload and intermodal segments to drive the earnings growth.
When you step back and synthesize all the data points from this report, the overarching narrative is clear. We are witnessing a freight market that is rapidly rewarding operational discipline. Knight-Swift is thriving because they aggressively managed their network to eliminate empty miles.
Absolutely.
They leaned heavily into their internal equipment to drive a 34.9% revenue explosion in intermodal. They exhibited the discipline to willingly sacrifice 16% of their volume in logistics to protect themselves from unprofitable freight. And they executed brilliant financial engineering to lock in 1% fixed debt while protecting shareholders from dilution.
It really is a comprehensive blueprint for how to operate a massive physical network in a supply-constrained environment.
It is. But for you listening right now, I want to leave you with a much larger macroeconomic question to consider beyond just Knight-Swift's stock price today. This earnings report proves that driver availability is already tightening structurally. It proves that the largest fleet in North America is turning away freight at twice the normal rate because they are maxed out, and they are optimizing every single mile just to handle current everyday demand.
Which points to a very fragile equilibrium.
Exactly. So think about this. If the logistics system is already this tightly wound and physical capacity is already this constrained right now, what exactly is going to happen to the global supply chain when consumer demand truly spikes during the holiday season?
That's the million-dollar question.
Are we looking at a highly efficient, finely tuned machine?
Yeah.
Or are we staring at the exact recipe for the next massive supply chain bottleneck?
The companies holding the physical assets will be the ones deciding who gets their freight moved and at what price.
It is definitely something to keep an eye on as we head into the back half of the year. Make sure to follow the show for our daily earnings coverage so you never miss the numbers that are actually moving the markets.